I've seen so many people that talked at conferences, and I realized ultimately I'm not sure they really have the solutions. And I've analyzed for myself what we need to do in order to tackle climate change. Nearly 25% of our emissions are land use. I thought always climate was all about energy. But actually, when you look at the statistics, it's not. It's actually about how land use change. It's the next thing that investors will have to deal with. We know that there's an economic value that nature is providing, but we're actually not transporting it into a financial value. In an ideal scenario, if you ask me what is natural capital investing, is that you move from an economic value into a real financial value. Our mission is to mainstream natural capital. To really scale, you have to also have scalable investment opportunities. We want to build a very large scalable business around natural capital. There's a business opportunity to create a natural capital investment business that attracts large institutional and corporate investors. 15 years ago, if you ask institutional investors, what are you doing on climate? They say, yeah, climate is a really big problem, but I can't invest in it. And now it's the biggest investment opportunity around. I think we will advance in the same way on nature and will become clearer to investors where the opportunities are.
Martin, thanks for coming on the show today.
Well, thanks for having me.
It's great to see you. You're in London now, but you grew up in northern Germany and I think near Denmark. So tell me about that.
Yeah, sure. So that's right. So I'm half Danish. My father belongs to the German minority in Denmark, and my mother is German. And as you may know, in that part of Germany and of Denmark, they moved the border around quite frequently over the century. I think there's a famous saying, like in the late 19th century, Lord Palmerston said there are only three people that know the kind of the answer to the question of Schleswig-Holstein, which is the state. And one person is dead, the other one got mad, and the other one forgot. So that's how complicated it was. And it kind of moved around. So my family is actually from basically in what is today Germany, but used to be Denmark. And then my father, when he grew up, he moved actually now in a part that is still today southern Denmark. But he grew up speaking German. So we're actually German-speaking family, but we all had Danish passports. And then at some point, I think when I was 16, I decided to change my citizenship. And since then, I'm German.
Your formative education was all in Germany, but then you spent 1 or 2 years in a high school in America, in Connecticut and Massachusetts?
That's correct, yeah.
Yeah, so that's where you learned about America view of the world, and when you developed a great appreciation for macaroni and cheese?
Well, I would say some other food in the US, not necessarily macaroni and cheese, but I was a teenager at that time. So I did what was very common back then to do a high school year after 10th grade. What was our 10th grade in Germany, mainly to learn English. But I think actually for me it was a lot more. I went there, had a wonderful family. And most importantly, I grew up in a very small village on the Baltic Sea. And I think you have to understand, I actually listened to an interesting podcast about the 1990s the other day, and it was playing here in the UK, and they basically said, well, look, back then in the 90s, everything was 6 months ahead in the United States. And it's so true. So you can't imagine today with the internet and all those things, but a movie would show up sometimes, well, at least 6 months, sometimes even a year later in Germany than it was shown in the US, because it had to be dubbed and they didn't have the same distribution schedule. And so when I grew up, we looked to the States as like this place of modernity, basically. And so I had a great year in the US. I think also I really subscribe to the attitude, a can-do attitude. Germany can be at times quite stifling. It's quite a hierarchical country in my mind. Don't forget, it's a brilliant country, but I think it's not necessarily a country that opens up the opportunities in the same way, at least back then, I thought the US would do.
That's really true, because I was already living in Switzerland in the 90s. I was flying internationally all the time. And I'd get on the airplane, and a lot of times the movies in the theaters, which in Switzerland you have to pay 20 francs for to go see, were being shown on the airplane already. That's all completely been erased in the meantime. That is a funny thing, because it was like that. What other observation of being in America?
I think it was really that I learned a lot about myself. I was away from home for the first time for such a long distance. I learned a new language. I didn't speak English that well. I almost didn't make the year because I was a good student, but I had two subjects that almost hindered me to go, and one was English and the other one was French. And what I think the irony is now, especially if my French teacher would be see now today that I lived in France, I actually speak French, you would not believe it. So I think it was almost an irony that I couldn't go because I nearly failed both classes. And then in the end, the English teacher said, well, I think if you learn one thing over there, you will learn English, and actually he was right. So yeah, so I learned another language, and but I think most importantly for me, it gave me a lot of self confidence, and it really installed in me that there is no limit in what I could do. And that when I came back, I felt immediately very stifled in to go back to this small town, and I always thought, okay, how can I kind of do something different? And the other thing, I think the other bug, if you will, I got during that time was that, so I was with the American Field Service, which is the organization that sent us over there. Those were the I think the ambulance driver in the Second World War, and they installed a program for exchange students so that people get to know each other, and saying war would be impossible if international people just get to know each other. And so they emphasized a lot that there was also lots of gatherings of international students. I had lots of friends that I gained from all over the world, and I think it opened up for me. It gave me kind of this international bug. And so if I knew two things, was that I would like to live and study in the US at one point in my time, and the other one, I really want to work internationally. It really suits me.
And then in 1996, you were off to Bonn, back in Germany, and you went to the University of Bonn to study politics, history, and international law. What was the idea behind that?
Well, to be frank, I actually didn't really know what I wanted to do, but I knew I was very interested in history. I was interested in politics, and I didn't also exactly knew what I wanted. I think I knew what I didn't want to do. I didn't want to study law, and I didn't want to become a teacher. And these were the only two recommendations I got when I grew up in northern Germany, what one could do. So I tried something completely different. I think I could have gone in various directions. I was very interested in history. I worked for an historical institute on the side, but actually, I'm sure we're coming to that. Then by happenstance, I actually got into the whole topic of climate change.
And I guess as fate would have it, the UN Climate Change Secretariat, in fact, is based in Bonn. And so somehow you got an internship at the first UN Climate Change Conference after COP3, Kyoto Protocol was signed in 98. I guess you were a student, but in those nascent days, the only qualification to go to COP was what? Speaking English, a little French, and maybe to be able to steam up a mirror?
You're well informed. Well, it was, so firstly, I think studying in Germany back then was still very different. So we didn't really have BAs. So you could only do a master program. And if you lived in Switzerland, I think maybe Switzerland is more organized, but in Germany, there were lots of people that studied for a very long time. And I think that was kind of the things that lots of people say about German. And it was probably true in that time. It was really seen as a time where you could try out different things, and you had a lot of time, and you had a lot of time to work. And most people like me had a student job and next by. And so I was looking for a new one, and a friend came and said, look, there's this UN organization, no idea what they're doing, but they need people that speak English. You speak English really well. Why don't you try that? And they pay really well, and you don't have to pay taxes. And I said, well, that sounds really interesting. And that was my introduction to the UNFCCC, so the Climate Change Convention. And as it happened, I didn't know that, but it was the first conference after the Kyoto Protocol, which was a predecessor agreement to the Paris Agreement. After that was actually signed. And so I showed up there in Bonn, and that's how it started.
And then you graduated. I understand you wanted to work for the UN, and eventually you landed at the OECD in Paris in a small climate change unit. So this began your Ernest Hemingway period as a young man in Paris?
So firstly, I did this for 3 years while studying. So and the UNFCCC was very, very good to me. They took me on a few conferences. I had my first COP6. I think we're now at COP28 in The Hague. Yeah, and then I tried, to be fair, I tried many things after I graduated, and I landed an internship at the OECD, and they were a small unit back then, I think not even a real division, that was focusing on the international negotiations around climate change. And for me, that was a great opportunity. So those were all, I think to this day, these are all specialists in their fields around economic, financial mechanisms, around emissions trading, lots of scientists that understood the science of climate change. So it was almost like a paid university for me, to initially as an internship, and then they actually kept me for nearly 2 years.
And then following that, you went back to the US to study at Columbia University. And I believe you studied energy. So why energy, and why at Columbia?
I tried various graduate programs. So firstly, I think my colleagues and supervisors at the OECD, they were pushing me very hard. They're saying, look, you should go and study. You should really brush up also on your financial and economic skills. And you should also study in the US because we all study in the US because that's where people study, basically. So that was kind of what I was doing, which suited me very well. As you, with my background, that was really one of my dreams. So I think I needed that push because it's not the obvious, let's say, thing to do for a German. But I figured it out. I applied to quite a few universities, and in the end, it worked out in Columbia. And what I wanted, why I studied, so I did a master for public administration, which is kind of an MBA for the public sector, which also allowed me to do all the macro, micro statistics, accounting, financial things that I was lacking with my political science degree. But particularly, I also had an opportunity to specialize. And I nearly worked 2 years then on climate change at the OECD, and I've seen so many people that talked at conferences, and I realized, what ultimately, I'm not sure they really like that. They really have the solutions. And I back then analyzed for myself, well, what we need to do in order to tackle climate change, we have to change our energy systems. We have to move to cleaner form of energy. So I need to learn. I need to understand how the energy sector works in order to have a career in that. And that kind of led me to go to Columbia. They have a very different program than what they have today. Jason Bodov today, you may know him. He's running a fantastic program there. Back then, it's actually run by former practitioners. Many of them came from the oil and gas business, and they really gave you an almost like a practical course in how the energy sector works. Lots with hands-on modeling, quantitative analysis, risk analysis. So it was for me a really good program to give me some real skills.
Around 2005, you finished your freshly minted Masters of Public Administration in International Energy Management because you wanted to better understand the climate change problem. And you said it was your dream to work for the UN, and you went to work for RNK Capital in New York as a carbon finance specialist. Now, RNK, if I'm right, is actually a hedge fund. So after being at the UN and the OECD, I guess this was a big change for you and must have been a true hands-on course in the rough and tumble world of capitalism. And at the same time, you're a carbon finance specialist. This is 2005. That was early doors for carbon finance. So what did a carbon finance specialist do in those days?
Maybe just on the UN thing, I actually set it up that I had a job at the UN. So I was waiting to start my job, and I met, well, actually, there was just a small notice on a notice board at Columbia. Hedge fund looks for environmental specialists. And I had one interview, and that hedge fund manager, Rob Coulton, he just hired me on a handshake. I actually didn't know that I had a job until I came out. And I asked it was sort of COO that worked for him. It's like, what happens now? He said, well, you come Monday. You just got a job. Congratulations. And I was like, okay. And so I did this for 1 month, and then called the UN that I wouldn't come because I liked it so much. So what did RNK do? So they were an environmental, I would say, fund much more than just climate change. So they raised back then, I think they had over 500 million under management. They had on the one hand side an energy long short hedge fund where they were trading on a daily basis, and then they identified an opportunity under the Kyoto Protocol, which is the treaty that I mentioned earlier. And that Kyoto Protocol allowed for governments to trade emission allowance between them. Back then, you have to remember that developing countries back then under the Kyoto Protocol actually didn't have any obligations. So the UNFCCC has this concept of common but differentiated responsibilities, and it was seen that developing countries, and they were listed in the Annex 1 of the Kyoto Protocol, they didn't have any obligations, but the flexible mechanism, in particular, the clean development mechanism, allowed them an opportunity to allow projects within their borders in order to reduce emissions. And these emissions could then be sold to, initially the idea was to countries, the so-called non-Annex 1 countries under the Kyoto Protocol. And so this whole concept of emissions trading was developed. And the idea was, from an economic perspective, the idea was very simple, to saying the most efficient way is to look for the cheapest ton of CO2, given that it's a global problem. It doesn't matter where we reduce a ton of CO2, whether it's in the US or in Brazil, has the same outcome. So why don't we look for the cheapest way of generating these tons in emerging markets and developing countries, and then use them for obligations under this treaty? And so that was a government-run opportunity. I think the real opportunity actually emerged when in 2005, the EU emissions trading scheme was founded. And that EU emissions trading scheme, which is an allowance-based system within Europe, which binds companies to basically over time ratchet down their emissions, otherwise to pay for the additional tons of CO2. These companies could, for a certain percentage, use these credits from emerging markets instead of buying a ton in the EU emissions trading system. And that created a business opportunity, actually a quite significant business opportunity, because just to give you an idea, prices were obviously fluctuating, but there was at least a 10 euro difference in the beginning between the price you would pay for a project in an emerging market and what you could sell it in the EU emissions trading scheme. So you had a significant spread that was there to exploit by financing these projects or buying these credits and then delivering them compliance bias in the EU ETS. And that's basically, we had an environmental fund that was trying to exploit this business opportunities. And it's really interesting. Back then, today we're talking about impact. Your whole podcast is about impact investing. And we probably did this already, but we didn't do this back then with that impact focus. It was a real business opportunity. It was seen as something that could be a very significant market. And the margins were very, very interesting for very commercial players in the market.
It just strikes me as being odd that in New York back then, this was seized upon as an opportunity. I mean, what was driving that?
Well, I think in New York, you had quite a few experts on emissions trading. Don't forget, the whole emissions trading concept was invented in the US with the SOX and NOx trading. So there were lots of traders and experts that helped bringing these markets to fruition. And they were very successful, both from a financial perspective, but also from a policy outcome perspective. So when any textbook you pick up about emissions trading, that's your first example. It's a SOX NOx trading that the US actually installed. And what's really interesting is that the US was then the biggest proponent under the Kyoto Protocol in order to make sure that the emissions trading was in there. And then famously, they never really signed the Kyoto Protocol, as you may recall. So they actually never participated. So the US never participated. And it was the Europeans that fought and like nail and tooth not to have any market mechanism in the Kyoto Protocol, that in the end were the ones that installed it in the emissions trading scheme, and then it flipped around. From a sudden, the Europeans were the biggest proponents of emissions trading as a cost-effective tool to tackle climate change.
That's why it strikes me funny, because it's been flipped.
Yeah.
I mean, 2005 was early doors for all this. Why did that attract you enough to pass up the UN opportunity that you had wanted?
Well, firstly, I think deep down, when I worked at the OECD, we worked a lot on emissions trading. So what the OECD was, they wrote papers, did workshops, they looked at very let's say specialized aspects of the Kyoto Protocol, but ultimately they were all related to emissions trading. How can you actually make that work? How does a baseline work? So I had a lot of kind of theoretical knowledge, and I was always eyeing, is this possible to actually make a career out of that? But I really deep down thought, well, that's not really possible. That's not a real career. That career doesn't exist. So the UN is a safer bet. And that's actually something I probably would have enjoyed as well. So I was deep down always wanted to kind of see, is it possible to actually go into that field? Because I was fascinated by that, and also very much subscribed just from a theoretical perspective, that if we want to fight climate change, then we should use for the least cost option. That's the only way we can also sell it at home, so to speak, to the ones that ultimately have to pay for it. So we ought to look for the lowest cost ton of carbon in order to make this work. And here I got an opportunity to do it hands-on. We did things like the first big project we've done back then was that we covered the two landfills in Buenos Aires. So basically, we worked with a Canadian engineering firm, and they provided us with a turnkey solution that they came in, they covered the entire landfill, and then they captured the methane. Initially, they were just even flaring it just by the conversion from methane to CO2. There's a massive, I think, 21 times reduction of CO2 in these activities, and that allowed us to start generating credits under the Kyoto Protocol. I think back then that was so new. It was so fascinating. I learned basically hands-on everything. I mean, I in my energy classes done a lot about project finance, but this was different, right? So this was really kind of a lot of things were not done before, and I worked with very good colleagues there, also in particular from the legal side, that I kind of learned. It was a very hands-on learning course for me how to do these type of projects.
So then moving on around 2007, I guess you went to do something similar to that at Merrill Lynch, where you became a vice president, which sounds rather heady for a young man in New York. And it seems like you got there just in time for the great financial crisis and a front row seat to the merger with Bank of America.
Indeed.
So how did that come about and what were you doing there?
With more maturity in the market, so the business opportunity we had at RNK was really to buy very cheap and sell high to buyers. But with more maturity of the market, this became a more commoditized market, which means there was from a sudden a secondary market price on ice quoted daily. And from a sudden, the discussion was not, can you provide me with access to projects as cheap as possible? It was like, okay, can you deliver the ton to me? And do you actually have credit in order to do it? So the whole collateralization around the delivery of carbon credits became quite an important aspect of it. And I realized that in a fund you have a huge disadvantage there, and that the business was moving from smaller entrepreneurial players to bigger banks that had a big balance sheet. And also, I was quite, in doing my interviews, I was really attracted by Merrill Lynch's approach. They were very quantitative. They wanted to build a model that we basically could do what you would call probably today the classical physical to derivative trades. So we bought basically physical carbon credits, which fluctuated, the delivery volume fluctuated, but we sold them as derivatives. And let's say the business made money by managing that risk. And for that, you really had to have a good estimation how many carbon credits you could actually generate from a certain project. So we worked a lot with their quants. So I was kind of providing the impact, and we're working with their quants to build a model that allowed us to estimate what are the ranges of certain project types, and how does it look when we put this in a portfolio. And with that, we could even start securitizing the carbon credits. But in a very simple way, it's like we bought what we called non-guaranteed, sold them forward. There was a spread between the two, and that spread was basically the profit that the bank would do. In the same way they're doing this in oil or in other commodity markets. And again, that was a great experience for me because I learned a lot about how that was done for other commodities, and then we applied this for the carbon emission market. And again, it was something that only a few players at that time did. So I think we were, with probably a couple of other banks that also did this, we were pretty much on the forefront of that.
And how was the whole great financial crisis and the Merrill Lynch acquisition being sucked into B of A? How was all that?
To some extent, it was a really weird situation because you may also recall, yes, you had a financial crisis, but at the same time, you had what I think is now coming officially to an end, but what was called the commodity supercycle. So anybody who was dealing in commodities, despite the financial crisis, was doing well. Oil was trading at record prices, all commodities were up. That also was driving then carbon emission prices. So actually, we were in a business that was quite healthy, where the rest of the bank obviously had significant problems. And that was kind of, so we were kind of on a day-to-day, we were a bit insulated because we had like, I remember we had like one win after the other in 2008 and 9. And then 2009, we were thinking, do we even have an employer left? And so that was kind of when the whole merger, or whatever you want to call it, acquisition happened between Merrill Lynch and Bank of America. But it did mean significant changes for the commodities business because, of course, as you can imagine, there was a big review, and Bank of America had to get comfortable with the entire commodities business. But I think more importantly for me personally, what I already could see is that also the carbon emissions market, or the segment I was in, was coming to an end because the Europeans were only guaranteeing to buy the so-called the credits from the clean development mechanism until the end of 2012. And because we had a market-to-market book already in 2009 and 10, I could see that business opportunity was running out. And I had to think a bit, okay, what I'm doing next. And that was kind of that. So I think that was actually more, I think for me personally, that was probably I mean, of course, there was a very worrisome situation around the financial crisis, and I mean, I thought it was a great experience to actually go through that. I wasn't as affected as I wasn't in securitization, where it was really okay, pack your boxes and you're out. It was much more. The question was much more: you're in a very profitable business in a banking sector that has massive problems, and that was a bigger. That was actually more the question.
So the champagne never stopped flowing on your floors there.
I wouldn't say that, but it was a really weird situation. But I think it didn't feel like, let's put it like that, it didn't feel like we were at risk at that point in time, that we would necessarily be, unlike other parts of the banking system, which were obviously extremely depressed.
So around 2011, you left for the European Investment Bank in Luxembourg. So maybe you can talk more about that move, how that came about, and then what did you end up doing there?
So firstly, what is a European Investment Bank? So it's a bank of the EU. So you can see I made almost like quite a move from a very entrepreneurial hedge fund to an investment bank, and then to Europe's probably largest public bank. So they are, I think they have now a balance sheet of over 600 billion. They do roughly like I think 70 billion in lending annually for mainly infrastructure projects. So they had the task at that point in time to sell 300 million EUAs, which is just a currency after the European Emissions Trading Scheme. And the idea was, and it was actually a British MEP, so a member of the European Parliament, that had the idea. The idea was to set aside these 300 million allowances in order to raise funding, and mainly for carbon capture and storage. So even already 2008, which is interesting because we are 2024 and we're still talking about this future technology, carbon capture and storage. But it was already back then identified that if we're serious about climate change, we need to remove CO2 from the atmosphere. One way of doing that is geological storage. But in order to go to demonstration projects on that, we would need a lot of money. And so the Europeans said, why don't we set aside, we don't have money from our budgets, so why don't we set aside 300 million from the emissions trading scheme? The EIB is selling it, and then we're using the funds in order to select demonstration projects all over Europe.
For people who aren't familiar, and I might include myself as one of them, EUA is effectively a futures contract for allowances issued by the EU emissions trading system. Can you just define that a little bit more for people who know nothing about this?
I mentioned the European emissions trading scheme. The way it works is that by now, back then it was slightly different, but by now, a company in Europe that is, I think 60% of the entire industry in Europe is covered, has to actually buy carbon emission allowance for each ton it emits. So if you're a steel producer or an energy company, for any ton of CO2 that you emit, you have to first measure it, you get it verified, and then for any ton that is being emitted, the company has to buy a ton of CO2, and the unit for that is called an EUA, which is called an EU allowance. So that's and that EUA is the equivalent of 1 ton of CO2. And so we have, I think, this is quite significant market. It's the largest emissions trading scheme in the world. So there are millions of credits nearly auctioned and sold every day at the moment, because any economic activity in the EU will have to now be basic for any activity. You will have to surrender EU allowances at the end of the year. But they're not futures contracts, so there can be any. So the financial instrument is being created by the finance sector. So the commission doesn't, they just issue the allowances, and once you hold it, you can trade it as spot, you can trade it as future, you can have options. It's a unit that is being used, and then it's basically like a ton of oil, right? It's like WTI or something, the equivalent.
And then who's the counterparty? It's the emitter that needs to buy it. Who's the seller?
So today, it is that the government auctioning these certificates today, the auctions, and then the buyers are either intermediaries, like banks, in order to create a forward market because they issue a spot, or they are basically large industrials that need the allowances. But usually it's really that the banks and other financials are providing the forward market or the futures market for that, and then the emitter buy them when they actually need them.
So you went to the European Investment Bank. You were doing what with the EUA?
So this was the first time, pre-2010, 11, most of the allowances were actually given out for free. So the commission started not to sell them from day one, because that would have been a massive change. So initially, companies got these for free, and then it was the first time that they would actually move also towards the auction system. So what we did is we got these 300 million, and our job was to place them in the market, and the money that we would get, we would then use for project investments in order to finance demonstration projects. And it's a very clever public finance mechanism that is only possible if you have a very large emissions trading scheme. And the EU is actually doing this again now. There's another fund called the Innovation Fund at the moment that you sometimes see popping up on some news clips where there's some very innovative technologies being financed, and then usually there's some EU grant, and then usually comes in from this innovation fund. So it's a multi-billion funding program for them now.
All good things come to an end, and at one point, I guess you finished this. It was a successful program, but it finished, and then you moved to another part of the bank on the equity side.
That's right. Yeah. So then I had to reinvent myself because that was a one-off. Unfortunately, I thought I had hoped that we would get many of these type of assignments, but they didn't. So I started off in the treasury, and then I moved to the equity side, where I ended up in a team that was doing innovative new transactions around climate and infrastructure. So we did a lot of fund investments, but we also did some direct investments, and the idea was really initially to do things to think about new business models. And the other one was to find structures that would allow to leverage in the private sector, which back then, so that's 2012, 13, was still relatively new. So it's like, how can we use public money in order to, as risk capital, in order to get private finance to go into areas they wouldn't otherwise go.
You were kind of getting involved in impact investing effectively. So that's where you had your introduction to that. And 2012 was really early doors for that development. Talk a little bit more about what you were actually doing.
We basically had a budget to invest in different types of businesses. We did a lot of fund investments. So for example, the Eco Enterprise Fund that was also
Tammy
here.
Newmark.
Yeah, exactly.
Yeah.
She's for example is one recipient from EIB funding. So we were selecting always fund managers or projects that we think could not only provide a return because we had to get our money back, but also had what you would call today an impact focus. So we would call it that they would actually fulfill EU policy objectives. That's what it was called there. But it's sort of, that's what kind of the EU institutions doing. They're looking for their own objectives, which today you would call impact. And through that, I came on the whole question of biodiversity, nature. So as I said, I initially really started out on the energy side and did a lot of energy work. And we already looked at back then there, and actually it wasn't really called natural capital in there. It was much more biodiversity, nature. How could you actually integrate natural infrastructure, green infrastructure, nature into real business opportunities? And it goes back to the whole notion of that biodiversity provides a service to humankind, but we're actually treating it as a free service. And because it's free, we're not actually valuing it, we're doing the opposite, we're actually destroying it, which is a bit countercyclical. So the idea was like, what type of businesses can we support that actually turn this around?
So what was the genesis or the impetus behind this? What motivated the European Investment Bank to push in this direction?
I would say that wasn't a top-down decision. I think the top-down decision was just saying we also need a place at the bank that does innovative new things. But what innovative or innovation was being pushed very much was driven by personalities. And so back then I was working with colleagues that very much looked into this and said, look, this could be the next big thing. And this is something we as a public bank should really push for. And because that we're very focused on climate now, but nature could be actually the next, so to speak, big thing that from an environmental perspective, on the one hand side is becoming a real environment, like a degradation could become a real problem from an environmental perspective. But on the other hand, also, it can really help to fulfill climate goals.
So you were making investments, were these equity investments only, or were these equity debt?
We tried different things. So we had one product which was mainly focusing in fund investments, and there we supported some of the very early funds in that space. And then the other one was we actually then worked on a facility which is called the Natural Capital Financing Facility. And that was a debt product. So, and the reason why it was a debt product was because there was some European Commission money available that should help and quote unquote normal EIB investment to also support then biodiversity or natural capital purposes, which was very tricky because in the end it was very difficult to find a loan product that was meeting on the one hand side the EIB criteria, on the other side really then could finance natural capital or biodiversity, because equity would have been probably the better product. But having said that, we found some good, interesting transactions. So I think the one transaction where it really worked was that we were able to, like, I think that was an EIB loan to the city of Athens, and they were doing a normal municipal loan, and we were able to attach a smaller ticket for natural capital. It's very difficult to use like their standard loan until we have a bit more clarity how the business model can look like.
So you spent a bit of time there, and I can see now that's where you really met impact investing and also nature at the same time. You referred to Tammy Newmark's fund, Eco Enterprises. You actually made an investment.
I did not. So I was part of the team. There was a colleague that did that, but we all looked at that. We also did. I think there was another fund family which is now under the fund manager Mirova. There was an Althelia Climate Fund. There was a Sustainable Oceans Fund, Land Degradation Neutrality Fund. Those are all things that we actually helped to get to the first close, often also with blended finance, so with governmental funds, where we combined our own funding from the EIB balance sheet with governmental funding in order to offer a different risk profile to other investors that are coming in. So the EIB's role was there then to, on the one hand side, signaling that we've done our due diligence, that we're convinced about the business strategy, and then also have some real risk reduction through the governmental layer that was sitting below the private capital that was sought to come into the fund.
And for people listening, I did an interview with Tammy Newmark. Her fund is Eco Enterprises Fund, and she invests in nature for over 20 years now in Latin America. She's completely Latin American focused. I don't recall the episode number, but if you're interested, you can listen to that. It's around in the episodes 20 something, I think. And then you stayed a good long time for several years at the European Investment Bank, but then mid 2020, which was interesting time for all of us, you moved to London and joined Pollination. So right in the middle of COVID. How did that come about? What was the impetus behind that? And also describe what Pollination does.
So Pollination is an investment advisory firm. It was founded in late 2018. And I started already speaking to one of their co-founders in 2019. The idea was to join them and to help thinking through opportunities to also have an investment business in addition to their advisory business. So it was really early days for Pollination. They were just a year old. So I decided in early 2020 to join. And back then, there were some private reasons for me as well. As a family, we wanted to go back to the UK. I mean, I should have said EIB is based in Luxembourg, so we were living nearly 10 years not in Luxembourg. So we wanted to come back as a family. So it was a good opportunity, but not as clearly defined. But what has happened is just before I joined, there was a first meeting with HSBC and HSBC Asset Management on the idea, could we work together to, I think initially really in broad terms on transition finance or some other impact investing. And it was then HSBC that when they looked through the deck that we presented initially, that they said, well, we're really interested in natural capital. Can you help us to build something around natural capital? And so it was a back and forth. And as you say, it was just when COVID started. So it was actually done all over Zoom. But then the decision was taken from HSBC to say, well, why don't we do a joint venture whereby we form a brand new company? And that company, this joint venture between Pollination and HSBC, they are investing in natural capital and building out a funds business and asset management business. And that's exactly what we did. So it took 5 months from March 2020 to August to negotiate this, and then we announced the new company, which initially was called HSBC Pollination Climate Asset Management, and then over time we dropped the first bit, and so now we are called Climate Asset Management.
It would have been a mouthful.
Yes, it was a bit too long.
So we're both HSBC and Pollination initial founding investors in this then?
Both of them are shareholders. Both of them provided the share capital in order to start the company, hire a team. We were just a few people from Pollination joining from Pollination to Climate Asset Management. There were 2 colleagues from HSBC that also came over. So we had just a small team of less than 10 people initially in order to think, okay, what are we going to do now? And the idea was to launch at least one, if not more vehicles in relations to natural capital. That was really the goal.
On the HSBC side, was this our mutual friend, Daniel Clear?
So Daniel Clear, who also was here on your cover. Now, Daniel Clear was back then the advisor to the CEO Noel Quinn. So he was on the group side. Our shareholder is actually HSBC Asset Management. That's headed by Nicolas Moreau and his team. They are the one that actually are showing. So it's the asset management business of HSBC, but the HSBC group, of course, had to be involved in that. This was something relatively new for HSBC at that point in time. So Daniel, I think, was involved in the background in discussing is this something that HSBC should do, and from what I hear, was very supportive of it.
So then how did it happen that you ended up leading the new climate asset management company?
Initially, I was not leading the company. So initially, there was actually the person that brought the parties together is a gentleman called Christoph Kutscher, also German, former UBS executive, and he was our first CEO and also chairman for until May 2023 when I took over as a CEO. So initially, I was helping to set up the first strategy, which is our natural capital strategy. And then I was tasked to lead our second strategy, which is our nature-based carbon strategy. So I had initially more of a strategy role, and then I moved into leading one of the two business sides of climate asset management. And then in 2000, well, in early 2023, the shareholders asked me whether I would be willing to take over as CEO.
I made you carry a lot of water to get to the point why we are even speaking today. So let's talk now about climate asset management. So give me a high level introduction and overview of climate asset management and include in that what's your mission and what's the company's main activities and key strategies and number of funds, etc.
It's very simple. Our main mission is to mainstream natural capital. So one of the observations we had in the beginning was that natural capital to this point was a very much of a niche product. So there were lots of smaller impact funds, some very good, as Tammy's fund, for example, but they were relatively small. And what I learned at the European Investment Bank was that in order to really scale, you have to also have scalable investment opportunities. Otherwise, you can't attract real mainstream investors. So in a way, that's really the mission that we're having. We want to build a very large scalable business around natural capital. I think we saw, if you think about almost like a Venn diagram, we saw basically the smaller impact funds. We saw the more mainstream agriculture fund and the more mainstream forest and timber funds, or TIMO supported or TIMOs. And our analysis was that in the middle of this Venn diagram, there's a business opportunity to create a natural capital investment business that attracts large institutional and corporate investors. And that's what we created. So we started off in our first investment strategy, which is a real asset strategy, where we're offering to institutional investors to invest in underlying projects, mainly around agriculture and forestry. And what we're doing in a nutshell is we are for this strategy, we are buying land in developed markets. We always have a thesis why we're buying the land and how we improve it, how we improve the impact, but also the economic return. And then we're selling it after 15 years. From a business perspective, so the way we make money is that we are creating sustainable yield. And the thesis here is that often you can create better long-term yield if you have a longer investment horizon. So for example, on the agriculture side, the traditional model has been to invest, usually to lease lands, and then to have an investment around 6, 7, maybe 8 years. And then by definition, you're required to get as much out of the land as possible, usually with not very friendly environmental practices, using a lot of pesticides. So we wanted to turn this around and saying, if we had 15 years, what can we do? We can actually implement very sustainable or more sustainable practices that also create over time, over the 15 years time, better yield, and they enhance the value of the land. In addition to that, we also look to bring in new revenue streams from natural capital. It could be CO2 for forestry projects or carbon credits, but it could be also conservation easements in the US. And we also measure all the biodiversity so that should there be a possibility to also receive a financial return for that we will then be able to also integrate this in our strategy. So that's one strategy. Maybe I pause here because I'm sure you have lots of questions.
You have two main strategies, correct? One's
That's right,
natural
yeah.
capital and the other's nature-based carbon.
That's correct. And that's the one I used to head. And that's a completely different strategy. So here we looked at what other opportunities do we see around natural capital. And one thing we saw is that corporates came to us and said, look, we have a net zero target. We know already today that we won't be able to fulfill this with own action alone. So for the delta or the last piece in the puzzle or the last part of the journey, we will have to buy some carbon offsets. And what we want to do is don't want to go now to a broker and buy them. We actually want to invest in projects, high quality projects from nature or natural capital that can generate high quality offsets for us over a longer time period. And so we created as a second strategy also a vehicle that allows corporates to put money upfront into projects. And what we're doing is we're not buying land because it's an emerging market strategy, but through a contractual arrangement, we basically are able to prepay projects and pay for high quality carbon credits on delivery over time. And that strategy, we are not delivering a financial return, but with that strategy, we are actually only delivering the carbon credits back to our investors. So we have two very different strategies. On the one hand side, a very more classical real asset product for institutionals. We have mainly insurance companies in there and some pension funds. And then we have the other one, which is a corporate product in emerging markets where we're helping them to invest in and source high quality carbon offsets. And so that also allowed us to run these strategies in parallel because they're completely independent from each other, but we can actually cross-fertilize some of the talent and some of the experience that we have in the firm.
Just to fill out the picture on climate asset management, how many funds do you have and how many employees and just a few other things just to get the high level?
We have those two strategies, 3 vehicles, and we have now over 40 employees.
3 vehicles, meaning funds that you're
Yes.
using. Are these open-ended, closed-ended funds?
They're all closed-ended. They're all 15 years, and we think that's one of the key criteria that in order to make natural capital investing workable, one needs a longer time horizon. Actually, I think it would be even easier if you could go longer. However, that's very difficult on a closed-ended basis with many investors.
So roughly double the average private equity fund.
I would say the more comparable funds on the forestry side or on the impact side is probably 10 years, I would say. So it's probably.
I don't know if you publish AUM, but do you have any kind of reference point?
We raised over 650 million at the end of 2022. We are now at the moment finalizing our fundraising. So I can't give you the final number, but we are well advanced on that and will come out in hopefully after the summer this year with our final number, but we're in a good way.
And when did you start fundraising? Was that 2020 or was it 2020? 21. Right, right. Okay. So before we drill down more on the specifics, give me a clear definition of nature-based capital. And so everyone's starting at the same point as where Martin Berg is, and explain to me why it should be important to investors.
Sure. Well, we call it natural capital, so for starters, and what we basically refer to with is basically you say the earth, air, land, water, and biodiversity. You can think about it as the Earth planetary infrastructure, if you will, and that infrastructure is providing a service. In very simple terms, the bees through their pollen help us to almost sustain life on the planet, and yet we're not providing any value to the services the bees provide to us. And that's, of course, a known fact. But I think now the question is, why is it important to investors? Because in our view, we believe that nature is now the next thing. And this is for 2 reasons. On the one hand side, we're seeing a second, let's say, environmental crisis looming. And it's becoming, I think, very visible in parts of the world. And this is a biodiversity crisis. And yet that biodiversity crisis also has a huge impact on the climate crisis. Nearly 25% from all emissions are land use, land based. And I think, and I had it actually, it was interesting. I met the other day an old colleague And she put it in a really nice way. She thought, like, I thought always climate was all about energy. And I said, yeah, me too. But actually, when you look at the statistics, it's not. It's actually also all about how the land use change, how it's called in the UNFCCC kind of jargon. And why is this? You could say, well, why is this important to investors? And investors, many investors are saying that. But also investors said this 10, 15 years ago, why should I care about the climate? It's terrible what happens to the climate, but what do I have to do with that? And I think we think it's the next thing that investors will have to deal with. We saw it on climate. It starts off with the problem becomes clear from a policy perspective. The next step is saying, okay, how is it actually impacting supply chain of companies? Who is actually responsible for it? And then how is the finance sector imposed, and what risk does it mean for the finance sector? And then in turn, the moment we're talking about risk, somebody will say, well, that's something I learned in the hedge fund. Everywhere there's a risk, there's an opportunity. So where are the opportunities of investing? And I think it's very true. And I think that's something we've seen. If you look at the playbook, how climate became such an important topic for institutional investors, I think you can see why nature is just the next thing that could follow a very similar path. And that's why we believe that investors will not get around to deal with it. And from the interest from investors that we're seeing at the moment, I think they clearly understand that.
Describe what is a natural capital investment strategy, because you're talking about something that's distinctly investing and not just doing something, making a better world, but you're talking about something where you lay out capital and you expect a return. So what would be a good example of natural capital investment strategy, and describe where is the value in such a strategy?
And I think we have to distinguish between the economic value of nature and the financial value that you provide to investors. But I think you're probably more interested. Well, you're probably interested from where you come in both, right? But I think that's the crux at the moment, that we know that there's an economic value that nature is providing, but we're actually not transporting it into a financial value. And I think maybe that's the easiest way. In an ideal scenario, if you ask me, what is natural capital investing, is that you move from an economic value into a real financial value. And if you can build a strategy around that and you achieve an improvement of nature while also creating a return, then I think that's, for me, that's kind of the gold standard of natural capital investing.
Also, what asset classes are you focused on? Are you an equity or?
We are a real asset equity fund. We are basically in our natural capital side. We will apply also some leverage, but usually we come in as an equity investment, and later on we will optimize the asset with some debt, but actually quite moderately. And so it's similar to what you would see on the infrastructure side.
And also, do you have a particular regional focus?
Yeah. So for the natural capital strategy, we are in developed markets. We're investing in North America, in Europe, in Australia, and in New Zealand.
And then on the nature-based carbon, is that developed countries?
Yes, so that's the nature-based strategy. By definition, it's global, but given the price points that we're trying to achieve, we're mainly active in emerging markets.
Can you tell me about climate asset management's theory of change and the problem you're trying to solve?
We need to move capital from activities that actually destroy nature to actually helping to improve nature. And I think that's something I'm feeling really strongly about, that we only have a chance to address both the climate and the nature problem if we move larger pool of capitals into the right direction. I'm very much subscribing. I'm feeling very proud of myself if I'm able to move the course of a very large institutional investor by 1 degree or 2 degrees, rather than having a very small and perfect investment vehicle with a few, let's say, very sophisticated but investors on the impact side. So I'm a firm believer that in order to solve the big environmental problems we're having, we need to change how large-scale capital is allocated. And that's really our mission statement. That's what we want to achieve, and we're doing it only focused on natural capital. I think that applies to many other environmental problems, but that's really our, if you will, our mission statement.
You've identified two principal strategies, the natural capital strategy and nature-based carbon strategy. Am I saying those right? Is that the way you term it? Yeah. Give me one or two high-level examples of one of these investments looks like, just so listeners can picture exactly what the hell you're talking about, to make sure we're all thinking of the same thing.
On the natural capital strategy, I think the best project I can think of to describe it is we bought 1,800 hectares of land in Queensland and Australia. And at the moment, or that's like we're just in the process of converting it, but when we bought it, that land had only sugarcane planted on it. Sugarcane is notorious for being a monoculture and also being notorious for needing a lot of pesticides in order to provide the annual yield. And it's also known for having very aggressive runoff into the ocean, which in that part of the world has also severe consequences. For example, the bleaching of the Great Barrier Reef. So what we're doing is we bought that land. We are now converting it to macadamia with cover crop plantings in between. So where we basically moving from a we would say very unsustainable way of producing sugarcane to a sustainable way of producing macadamia. Macadamia is a really interesting investment opportunity, even if you, let's say, forget all the environmental benefits that we are producing with that. It's a super nut. In that part of the world, it's indigenous, and it has a great market in Asia for future demands. So it's also an attractive investment opportunity just on its own merits. But what we're doing with the land conversion, we are also achieving massive environmental impacts, in particular in regard to biodiversity. And what's special on this project is actually embedded between two national parks. And these national parks have some very rare plants. And what we're allowing is we're always setting aside at least 10% of our land for each of our projects. And with this set aside, we're allowing some connectivity of these national parks. And that means that these two parks can be connected. And one way to enhance biodiversity is to increase connectivity between or just to increase connectivity. That's one of the best ways to enhance biodiversity. So if you look at this is a really attractive investment opportunity, but it also has a land use change kind of thesis behind. And we can measure also the improvements over time that we're achieving on the ground.
So primarily it's all real asset.
Real assets, agriculture, forestry, those are the main parts of the strategy. Yeah.
And what is your average ticket size?
It depends. It's probably between 30 to 80, 90 million.
And you have a target return that you shoot for?
We do. So it's an 8 to 10. So it's a real asset. Yeah, normal real asset return.
Can you give me an example of the nature-based carbon strategy?
Just as one, it's a very different activity. So there we are not looking for an investment return in the form of a financial IRR, but what we are trying to do is to help the projects to get off the ground in order to generate high quality carbon credits. And I think one of our best examples is we're working with an organization in Kenya, Malawi, and Uganda called the Global Evergreening Alliance. And there we're actually installing agroforestry techniques with smallholders on the ground. So they're an organization that works with local implementation partners. They've been doing this already for quite some time and showing that mainly by planting trees, they can improve the livelihood of smallholders because with the tree cover, they can actually start to grow other things and they have a much more nutritious ground than they had before, which is also more resilient to drought. So it's a great impact story. We have some very wonderful individual stories, how it improves the life of the underlying farmers. But for us, most importantly, because we're planting so many trees, we're also having a significant CO2 reduction that we're getting certified. And then the certified CO2 emissions we can deliver back to our investors.
So in this case, you're investing money in acquiring this land and planting these trees.
We are not buying the land there. There we're working with the local owners of the land, and we're basically saying it's a contractual arrangement where we're saying we're providing you a prepayment for the carbon, and for the investment we are making in your project, you're returning us X number of carbon credits over a certain time period. That's how we deal there. It's too complex for us in order to buy the land there. And also it's not an investment strategy where we want to benefit from any value enhancement of the land. We actually we're very happy just to receive our CO2 certificates.
So it's a contractual relationship with the farmers?
Yes.
And so you have the ability to enforce and ensure that these forests don't get chopped down and so forth?
Sure. So you have of course contractual obligations that the counterparty has to fulfill, and there are also some remedies in case things are not happening. But ultimately, if the contract works as per plan, then it's almost like a self-exiting investment in that sense. we're providing the finance up front. We are getting a stream of carbon credits. Once that is delivered, we're out of the project. And the local community maintains the land and also maintains a future stream of carbon credits, which is very important for us because we actually want the local community benefits from these projects. So it's an ability to kickstart the project, to get a certain percentage of the underlying carbon credits to finance that, but to keep the control of the project and also the majority of the benefit with the local communities. That's very important for our investors because of this is the way they want to engage with the underlying project.
And then the revenue is the sale of the credits. Do you have a trading operation?
No, we don't, because we are working with corporates that actually want these credits and need these credits over time frame. So we're working with some of the investors that publicly announced that invest in our fund, includes GSK in the UK or Kerry in the US. They basically already today have their own net zero targets and know by when they have shortfalls and would like to use carbon credits. That's not today, that's probably in the future, but this is a 15-year strategy. So we are helping them to then receive these credits, and they're using them for their own compliance needs. So there's no trading involved in there. So it's a strategy that directly helps corporates, and the corporate funds are used to kick these projects on the ground.
And what is the target return for this strategy?
Well, so we agreed with our investors on a target price, and instead of having an IRR, the way you probably know it in a fund, what we have is for a certain, we basically agreed with them a number of carbon credits for a certain amount invested in the fund. That's how we work.
Now for the $64 million question, how are these two strategies interlinked?
I think there are two different ways in order to find a way to pay for nature improvements on the ground. I think that's how they are interlinked. And I think they're by design not interlinked, because as you know, if you're running two strategies for different investors and they're exactly the same, the investors will get very upset about it. So here we have it's actually a really nice setup in that sense that we're saying we have a real asset, developed markets, investment opportunity for an institutional investor, and we have an emerging market, almost like a more procurement product for compliance buys. I think a lot of the techniques we are using, how we're investing in the underlying projects, how we're pricing carbon, how we're assessing the environmental risk around that, how we are measuring the impact, they are nearly the same for both strategies. So for us, we have a lot of synergies between the teams, and we can use a lot of our experts for both strategies. But ultimately, they are distinct and by design distinct investment opportunities for different types of investors.
What is your investment process for each of these strategies? Can you describe to me how logistically or tactically or operationally you identify your investment targets? What makes a strong nature-based investment for you?
Sure. I think a strong nature-based investment has to achieve both the expected return and the expected impact. And so we're taking a lot of time and energy on assessing both aspects. So it's not good enough to saying here's a really good, for our natural capital strategy, here's a good opportunity just to achieve a high IRR. What we always say is like, okay, so what's the theory of change? How do we create impact? And how can we make sure that we also hit the target return for our investors? And on the carbon side, it's similar. We're looking into that, okay, we're not only looking for cheap carbon credits, but we're also having an impact framework that needs to be fulfilled. We're looking very closely on how is the local community engaged, who owns the land, who benefits in the end, how can we make sure that we not only achieve the carbon emission reductions, but also leave a sustainable project afterwards and have additional impacts on the ground. And I think, generally speaking, I think the philosophy is that we want to engage in investments where, in really simple terms, where we leave the land that we found in a better shape than we found it.
What would be examples of the key criteria that you're looking for?
On the financial side, when you look at this has to be in, so if you go back from the macadamia project, right? So, okay, we look for an opportunity to generate yield for our investors and ultimately generate the return they want to see. So that's the first one. So how can we do that with the underlying project? So that would be similar. I mean, if you did an infrastructure project, you would look at that as well. And at the same time, we're saying, okay, we're having what we developed on both sides is an impact framework where we have 4 high-level criteria that we're looking at with each 3 subsectors. So we have basically 12 impact factors that we're looking at. And we developed an internal scoring system that is both a combination that you hit as many of the impacts as possible, but that you at least have 3 to 5 substantial contributions to one of the impact factors. And that's the one we're looking at. That's the one we want to improve. It can be biodiversity, for example. Then we drill down what type of biodiversity. For example, it could be specific plant, or it could be certain birds. For example, in Iberia, we have projects where we're looking for birds. And then we're basically saying, okay, what's our baseline here? And how can we improve this with our investment activity over time? And so we set ourselves then, we estimate initially what the impact could be. And then we basically baseline the project. And then the goal is to increase the selected impacts for each project.
So is it iterative? For example, is it first it has to pass traditional financial analysis and then you look at impact, or is it impact first? Or do you ever sacrifice one over the other?
We had, especially in the first year of our company, we had endless discussions about that. Are we sacrificing return for impact? But ultimately, what we realized is that, of course, it can happen in a certain specific project, but actually becomes very quickly clear whether a project fits what we try to achieve. Like we always ask my investors as well, oh, what is if you have to sacrifice the impact for the return? And ultimately, it doesn't really fit our screening process. And the way it works is sometimes we get a project saying, oh, wow, this is great. If we could do this, we would have so much impact. And then the question is, okay, but does it stack up on the return side? So we have to do the test on the return. Sometimes it's the other way. Okay, this is a really interesting investment opportunity, but what is kind of the impact story? And this is immediately screened out in the team, but also this is one of the key discussions in our investment committee for each of the opportunities.
So the answer is it depends.
Well, it depends, but actually, you know what? We had this discussion. Yeah, as I said in the beginning, we had this discussion. Oh, we are sacrificing returns, but we actually found that there's so many projects out where you can combine the both. That when, for example, I'm a member of the IC. When we see it now, we don't have that black and white discussion any longer. There are always some nuances, right? Okay, can you improve this? Can we spend a little more money here in order to increase the impact? Is that really what we want to do, even though we are already above our impact threshold? These type of things, perhaps. But it's not as binary any longer. But what people fear, okay, you are absolutely sacrificing your impact. We see actually with the strategy we defined and with a longer time horizon, it is actually also in the financial interest of the investors to following them, in particular on the agriculture side, regenerative methods. And I think that's what you see now more and more. And you read it also more and more. There are more studies out there that demonstrate that it's actually not only something good for impact, but also good from a financial perspective. And that's exactly what we're seeing in our project.
Do things such as size or location or stage affect the risk return profile in your mind?
Initially, we thought, for example, on our real asset strategy, we thought you're achieving a lot more impact if you always go greenfield. But actually, we just engaged in Iberia in a transaction where we bought an existing agriculture operation, and we are now transforming this to regenerative practices. And we can, initially, the first question was, well, can we ever achieve any impact there? And actually, yes, we can. So I don't think it's necessarily the case that you can say because this project is here or is at this stage or is of this size, you produce more or less impact. So I wouldn't say that, because I think I don't know where your question was coming from. Probably it's more like you're saying, look, if I go very small and very early, then I tend to have a higher impact. That's not necessarily something that we see in our investment activities.
Yeah, you've given me a range of ticket size, and your experience is bigger, better in terms of cost versus benefit, or conversely, does it lead to a concentrated portfolio?
The whole strategy, when we go to an investor and they're asking us, aside the environmental benefit or the impact, why should I invest in that? And then we're saying, well, you should invest in that because these are uncorrelated assets and these are highly diversified credits. And by having a strategy that combines both agriculture and forestry, we're achieving both from the underlying project type, but also from the geography a huge spread. So we're highly diversified in that perspective.
How about the availability and pipeline of investments? Any challenges you found in allocating capital?
Of course, it can be challenging. Finding the right project is never easy. And initially, when you start out like what we do, the biggest challenge is to achieve a certain fundraising in order to be able to invest. Once you overcome that, and I think many of the podcasts that I listen to on your series, they also made that point. It's really difficult to find good project, right? So that's absolutely clear. We also see is that in the field, the more inbound ideas were coming. So especially on the carbon side, while it's very difficult to find the right project, we're seeing a lot of ideas and a lot of opportunities just coming to us. So that's really the positive of that.
Give me an example or two of an investment that you've made using this investment process that you just described to me, and explain the end-to-end process, how you operate, from how did the company appear in your pipeline or on your radar, and then how did you assess their suitability to get to the point where you finally pulled the trigger to make the investment, just to get a feel for how you operate.
So obviously the first is we get an inbound opportunity, or there's an opportunity that was known to one of the team. Then I think the first is usually high level assessment, desktop assessment, but then very quickly, if we're saying this stacks up, I think the most important thing is to actually see the project. So we always, one of the first things we approve is to go down to the asset and to understand it, to see it, because there's nothing like actually seeing the underlying opportunity and to meet your partners.
Is there a specific example that you could describe how you became aware of a certain company that you ultimately invested in? And also, are you getting pipeline from Pollination's activities, or is this just free inbound?
Both shareholders, wherever they see an opportunity, they will pass it on. As you can imagine, they have an interest that we find as many projects as possible. But we're doing generally, we're standalone, so we're completely independent. So also doing our own origination. An example how would work. So for example, with an academia project, that's the underlying project partner we're having is one of the experts on macadamia in Australia, and they were introduced to us, I think, very early on in our time as climate asset management. We were not really able to transact at the scale at that point in time. And so for more than a year, there was no communication whatsoever. And then at some point, they came back and say, look, we heard now you advance in your fundraising. We have another project in another region. We would like to work with you. And then it's basically very quickly, you sign an NDA, you receive information, you're down there on the side, you look at it, you start assessing, building your internal models. And then you're also starting very concretely how you would work with the implementation partner on the ground. And that then, once you kind of set that framework, then you're ready to start negotiating commercials aspect of that, and then I think you can move to contractual negotiations.
And with natural capital, are there key risks that you take into consideration?
Well, absolutely. So once you kind of made your assessments, built your models, then you need to start checking, right? You know what is there. So you do a very deep due diligence. One of the first things we do, and I think, again, that's mentioned on your podcast quite a few times, is we obviously want to improve nature, but nature also is one of our biggest risk factor, right? If we're doing in agriculture project, droughts, too much rain, too little rain, fires, all these things are obviously a huge risk to us. So one of the things we're doing is the first step is also to run a climate model because we have a 15-year period to see whether from a climatic perspective, this is actually an activity that we should be able to do in that region. So that's kind of the first lens that you do. And it's interesting what you sometimes find, right? Sometimes it's advantageous, even if it gets a bit warmer in a certain part of the world and you're expecting that for certain activities, sometimes it's a real problem. And then I think on the agriculture side, one of the huge risk factors is access to water. So it's having secure water access, being able to use it efficiently, but to use it is obviously one of the key. And then if we do a forestry project, it's things like forest fires and other natural disaster that could be there. So I think those are the kind of the key risks that we assess.
The devil's always in the details. You talked about running climate models for natural capital. I just spoke with Nish Majmudar at M&G, and he was talking about on the insurance side of the business. Originally, he discovered the opportunity because he felt that the people on the insurance side said, well, climate just hasn't been an issue over the last 200 years in the data. Is your data backward looking or forward looking? Because he claimed that was the flaw. They discovered that the backward looking models didn't project forward.
What we're doing is we're working also with data from insurance companies. I mean, the reinsurers, have been probably one of the longest participants around climate. So they've been always very active in around all financial mechanisms of climate because they obviously have the biggest interest in risk to have the best data. So, but what they're also offering us services where they're using what we're doing is we're not looking backward and then using that data. Past performance on climate is not really helpful for you to make a forward-looking assessment. So what you need to do is you need to actually have access to climate models and the numerous climate models, and then to overlay it with the geography you are and saying, okay, you are acting in this area, this is the type of activity you will do. So what is expected to happen here on average? Is it getting warmer? Is it getting wetter? Is it getting windier? And once you know that and you can actually drill down or in quite some detail to get that information, then you can see, okay, what impact could that have on my underlying project? So I think that's probably a pretty common activity now that most investors in real assets are now looking at, that they're not looking backward, but they're looking actually on the climate modeling to understand whether there could be an issue.
Do you have enough data now to know that they're proving to be reliable?
On the high level, you have some very good indication. You just have to go. I mean, it's all going back to the IPCC, which is this big scientific report that is published every 6 years or so. So I think you have a lot of data in there that you can use. But is it 100%? We don't know, right? We can't, of course, 100% foresee the future. But I think you have now quite a bit of data that you can use in at least to take an educated decision whether you need to. Well, you can do you can do an activity, or at least if you have a risk, and then you can see, can I mitigate that risk in some shape or form.
Are there risks that your investors are exposed to other than the same general market risk that all investors have with any investment?
I would say that, of course, there's a certain regulatory risk that they're exposed to, especially on the carbon side. The voluntary carbon market is not really regulated at the moment, so there's a risk, of course, for them that changes to underlying frameworks in the countries, how you can generate, for example, carbon credits, that could change, and that's obviously something that a lot of investors are looking quite closely at.
Your carbon-based strategy seems to be mainly focused on developing markets. Does your due diligence process change when you're focusing on these less developed economies?
In principle, you do the same elements. You have to do a good due diligence, and I think what changes it is sometimes a bit more complex to get the same type of information. So, I'll give you one example: land title in some of the emerging countries is much more complex to assess than, for example, in some developed countries. But ultimately, if you follow the same rigor when what you're doing, but I think the biggest difference is really, can I get access to the same data in for some of these investments that I can get somewhere else?
How about corruption in some of these markets?
Yeah, of course. So that's also part of that. So that's a big assessment. But actually, compliance, I would say, is a huge part of our assessment in all of our investments. I think, as you can imagine, with our shareholders, that we take that very seriously.
So when you have impact on the company shingle, obviously measuring and managing impact outcomes is what it's all about. What are the key performance indicators that you watch? How do you measure your impact?
As I mentioned earlier, so we developed for both strategies an impact framework that we're using. And so we are looking for example, on our real asset strategy, we are looking for biodiversity, for CO2, for water, and what we call natural social improvements. So we have different sub indicators there. And so we're trying to assess for each project what is the most important impact indicator for the project here. And we start off baselining the project. So what's the situation at the moment on the ground, and what are the indicators that can be improved over time? And then we're measuring over time against that baseline. So for example, on biodiversity, it really can mean that we're in the field and counting certain species or certain plants and monitor this over a 15-year time period to demonstrate that we can improve that.
To what degree do you risk experiencing impact washing? Is this even a thing in the natural capital investing space?
I actually find that the investors we're dealing with, they're pushing us actually very hard to make sure that what we present as impacts can be quantified, or at least that we have very good information before we comment on that. And I think that has changed a lot. So there's always this notion, oh, the investors don't really care about this. Our experience has been the ones that invest with us, it's actually the opposite. They go in the extra mile, and they want to make sure that whatever we're collecting on impact data, that they can actually use that. And some of them are even required now by regulation to do that. So, for example, the French investors, they have the Article 29, which now requires them to both collect climate and biodiversity related data. So they are not taking this lightly then in a way. So there's a real regulatory obligation. And I think that's one of you asked, like, what is kind of the risk that many investors are exposed? I think they are seeing that they are exposed to more regulatory disclosure requirements over time, and they want to invest in opportunities that can provide them the necessary data. So we're spending an awful lot of time discussing with that what the format is, how we're delivering that. And I think that's for some investors also a key driver to look at these investments, because what they're realizing is that if you go into a real asset investment, you go all the way to the ground and you have the raw data, and unless in some listed equity funds where it's very difficult to get the appropriate impact data.
Once you make an investment, how much involvement do you have with your investments? Do you allocate capital and let them run and count on your due diligence to have identified a really strong team and all that? Or is there some hand holding usually?
There's hand-holding, and the asset management is one of the most important piece of the investment process. So initially, the investment team does the analysis, does the structuring, does the due diligence, closes the deal, but then it's handed over to the asset management team. We are working in all of our projects with local implementation partners, but the asset management team is overseeing that, making sure that the contractual arrangements that we're having with the underlying implementation partners, that they're really fulfilled. And that's a full-time job over the entire 15 years time. And that's also where we make sure that either the return or the in-kind delivery of carbon credits is happening.
You described your funds as being closed 15-year funds. How long do you hold your investment?
It depends. It's probably a bit less. We have a 4-year investment period. So it depends how early on we are. And then when we start the exits, I would say it's probably more 12, on average 12, 13 years.
And what is your exit strategy?
On the real asset side, the thesis is that we will exit most likely to institutional investors that are very interested in having a portfolio of highly diversified, high impactful, yield generating transactions. And I think at the moment, when you look around, that's very difficult to find. So a lot of what we're doing is aggregating smaller projects into larger investment opportunities. And a lot of the projects after the 15 years will still have at least 15, sometimes even longer years live on the yield side, and that's very attractive to institutional. So that's for the natural capital strategy. For the nature-based strategy, it's almost a self-exiting investment in that sense that we're making a prepayment or buying credits on delivery, but when we get the last credit delivered, then actually the obligation is fulfilled, and we naturally exited that investment. So we have no exit risk.
So a lot of natural capital investments, by definition, a long time horizon to generate impact and returns. How do you ensure that you're investing in businesses whose impact will be preserved long after you've exited and comes much further out in the future?
In order to exit, we need to demonstrate that there's a long-term business. Otherwise, nobody would be willing to pay for it. And we get the question a lot. I don't know whether you're alluding to this. Well, what if somebody just kind of goes in and then forgets about all the impact? But we think that's a very unlikely scenario, because why would somebody pay for 15 years of impact creation, then come in and saying, I stop all the impact side and I'm just focusing on returns? That's a very unlikely scenario. And we do think that in particular the large institutional investors will want to look for these opportunities going forward. But we need to make sure that we can show that. On the carbon side, it's a bit trickier, because we in a way we're self-exiting, so we're out of the transaction, but there from day one, we want to make sure, and this is part of the investment philosophy for each transaction, that the local community maintains the project and also receives the benefits from additional stream of carbon credits going forward. That's very important also to our underlying investors, that we can demonstrate that for each transaction.
I want to discuss about an investment vehicle that you have with Apple, which is part of an extension of the Restore Fund. And if I understand it correctly, the idea is that this is working to allocate capital towards nature-based investments. Can you explain what this is and how does it actually work?
Yeah, when I said we have 3 vehicles by 2 strategies, this is the third one. And what Apple is, they are exposed to both of our strategies. So on the one hand side, they're investing in return, let's say the real asset side in order to generate in the return. And on the other side, they're receiving carbon credits through investment in carbon projects. And what we're doing for them, we're putting this together in one vehicle and also in one reporting framework so that basically they can see the investment in carbon credits as a real investment and not just as a cost. So in really simple terms, the return from the real asset side is paying for the carbon credits, and we put this together in one vehicle. There's a really unique way of looking at it because a lot of the corporates struggle with investing in carbon credits because ultimately it's a cost. There's no, at the moment, if they don't sell the carbon credits but use them for themselves, it's a cost activity. And so what we're doing there is we're helping them to make sure that this is actually an investment activity for them.
How did this come about?
That's, I think, their philosophy under the Restore Fund, that they want to combine these two elements. And I think in a way, we've seen that not only there, but other corporates are trying to find different ways how they can invest and receive carbon credits. You see this also, there are a lot of forestry funds in a way that are now in the market. I think you had Charlotte Kaiser from TIC last, as one of your last podcast participants, and they practically do the same, that they're saying you can invest with us in a forestry project and you can make a return from the sustainable harvesting of timber and also receive some in-kind carbon credits, and you can elect to that. So it's very common now that some asset management offer that for different investor types. And where we are different is that we are not saying we're doing it within the same project or the same project portfolio, but we're actually combining two project portfolios to have the same outcome.
The focus of this fund, it's not just for Apple, but it's also available for their suppliers. Is that true? And if so, how does that work?
That's correct. So they invited some of their suppliers to join, and the idea for them is to saying their suppliers are their scope 3, and the scope 3 is by definition the scope 1 and 2 of the suppliers, and that's one of the biggest problems we have now in our net zero world, so to speak, right? That my scope 1 and 2 could be your scope 3. So who's responsible for it? Are you responsible for your scope 3, or am I responsible for scope 1 and 2? And I think Apple tried to solve it by saying, I'm just inviting some of them in the same vehicle. They're using their scope 1 and 2. We're using our scope 3. And we can clearly show that this is actually an innovative way of combining that and not seeing as a conflict, but actually working jointly together.
What impact is this having in practice across Apple's supply chain?
Well, I think you have to ask Apple to do that, what it has. But I think, what I will say is that it's interesting that if a corporate, and this is not Apple, but we see if a corporate makes a clear statement that they want the supply chain to act, then actually they start really acting. So I think and Apple is not the only company there, right? So I think it's important that these big companies actually address it. Otherwise, change is not going to happen.
You've posted frequently on your LinkedIn about how such a small portion of global AUM is actually invested in nature-based solutions. What needs to change to encourage more capital to flow into this space?
It's a good question. It's one of the things I find puzzling because we have a lot of discussions with a large group of institutional investors. All of them want to talk to you about nature. A lot of them have very extensive internal groups that try to assess. They understand and they openly say, yes, we know this is something we will have to deal with, but we can't get our head around it. And one of the key things is that they can't find the right allocation for how they should invest into that. And the big question there is natural capital an asset class? Is it a sub-theme of real asset investment? Or is it a sub-theme of forestry and agriculture investment? Is it something standalone? And then that hinders a lot of them to get their head around. And then there's another group, I would say, that actually hasn't invested, at least not in a direct way, into agriculture and forestry for them. So that's also a big step to get into this area.
We've discussed your long background and different experiences that have been both on the public and the private sectors. Have you found the differences between investing in nature with private rather than public capital different? And what are some of the key similarities? And what are some of the big differences?
Firstly, I would say there's always this notion that the public sector is investing for no return, and that's not true. Any DFI or MDB needs to make a return because they're issuing bonds every year. So to some extent, I find sometimes that actually the public sector is probably much more or much clearer that they need a return. And there's sometimes that makes them sometimes very conservative. I think where the public sector can overcome investment risk is when they're using truly governmental funds, and when the funds are designed to leverage in private sector capital, because then these funds can take risks that nobody else can take. I think that makes a difference. But otherwise, I find actually at the moment that the private sector, in particular the corporate sector, is much more innovative in finding ways of investing in these type of fields, and also much more willing to take risks that nobody else is willing to take.
More and more natural capital investment strategies have appeared on the market in these last years, and there starts to be some visible momentum I think we've all seen over the recent past. How do you think this space will look like in the future and say, I don't know, 5 years or 10 years or 20 years out?
My hope and my view is that there will be much bigger allocations from institutional investors for mainly agriculture, forestry, around natural capital. I think we will find different ways to price biodiversity, which is the missing link at the moment. So all the things I described to you now, the biggest challenge at the moment is that we're actually using relatively traditional ways, agriculture, forestry, in order to create a value around nature. I think where we need to head to is that we also can price some of the value that biodiversity or the services around biodiversity can create, and that we can price them in, and that will allow them to build completely different financial instruments.
But as a percentage of AUM, it's relatively small.
It is relatively small, right? So if you look at the numbers, we have 100 trillion of GDP, roughly 4 to 5% is linked to agriculture and forestry activity. At the moment, I think we are not, a very, very, very small portion of that is actually invested. So I think there's a lot of room for increasing allocation in that space. And I think also the other way, I think in order to also price in biodiversity or other natural capital aspects, we would need a lot more measurement technology. So I think there's a lot of technology that can help us to do that. So I think it's not only, if you ask me, natural capital is not only a real asset in investment. That's obviously one opportunity, but I would see that it will be much more integrated into also technology investment. I think the next phase will be growth investment in that space. I think the private equity sector will wake up and see how supply chains and other companies are linked to nature. So I think that will allow to actually put much more capital into this field. It's similar to what we've seen in climate. So I think what I always tell people is 15 years ago, if you ask institutional investors, like, what are you doing on climate? They say, yeah, climate is a really big problem, but I can't invest in it. And fast forward to 2024, I think now it's seen, you just have to open any research report, it's the biggest investment opportunity around. So, and I think we will advance in the same way on nature and will become clearer to investors where the opportunities are.
Martin, I've got a few last rapid fire questions to wrap up our talk here. So just give me whatever comes to your mind, or if nothing does, you can also feel free to take a pass. But if you had to name the single most important challenge in the natural capital investing space at this time, what would it be?
Two, from an investment perspective, the lack of allocation, and I went through that. And then the other one is metrics for biodiversity to make them investable. I think that's something we have for climate. We have one metric, which is CO2. Everybody understands it. It's the same everywhere in the world. We need to find maybe not one metric, but a set of metrics that allow us to convert the same clarity to natural capital investing.
Common language.
Common language, ideally a common indicator which is measurable, but starting with a common language would already be a huge step forward.
And more acronyms. That's what we need in the financial business. What do you know now about natural capital investing that you wish you knew in 2020 when you showed up at Pollination?
I thought that the interest from some institutional investors that are always voiced at conference would translate directly into investment opportunities with these institutions. And I learned the hard way that actually, even within those large institutional investors, there are different constituencies and different camps, if you will, that generally speaking, the ones that work on ESG sustainable investment, they're very convinced and very clear this needs to be done, this is the next thing. But that doesn't mean that you can very easily convince an allocator to really change his or her behavior. So I think that's one of the things that took me a long time to understand the functioning there, and that you have to also speak sometimes a very different language if you sit in front of the allocator to explain to him or her why they should allocate money to this space.
You don't have to name names, but I'd like you to describe to me an investment that you made. At the time, you were convinced when you invested that it ticked all of your sustainability and impact boxes, but in the end, it didn't turn out. And what were the lessons learned from that experience?
Biggest lesson in regards to investment, I'm not sure whether all the impact boxes were ticked in the same way as today was, but it's one of the set of projects that hedge fund RNK we invested in was in Russian pipeline projects. And back then it was 2006. It was a completely political environment, but ultimately we invested in these. And actually, from a technical perspective, these projects were wonderful because they were very easy. We basically measured the emissions on pipelines, took out the valves, fixed them with Gore-Tex, and close them, and there was a massive emission reduction. What we failed to basically fully appreciate is that the Russian government back then was not really willing to participate in the UN mechanism, and while we had contractual obligations that secured us, and while we had even insurance, what I learned is, I was no longer working, that it took 7 to 8 years for the fund to enforce all its right and to get at least a large portion of their money back. So that was a huge lesson for me, and I kind of followed it initially from doing the project and then helped them to go through the entire kind of process with international arbitration and insurance tribunal to get the money back. And I think that was kind of one of the, for me, the most formative experience, kind of to see what it actually, because we're doing all these contracts and we're saying, oh, then we do a little bit arbitration here, a bit of insurance, what it actually means to go through the whole process before you get the money back. So that was one of the biggest lessons for me, even though a lot of that I didn't do directly any longer. I was already 2 jobs further on, but that also shows the timeline, how long it sometimes takes, even if you have very, very good security mechanism in your contracts, how you enforce them. So that's good lesson for me from an investing perspective, and I think it made me a better investor over time.
And now the converse of that, can you describe an investment that you had some level of skepticism that either at the time you invested or maybe you ultimately passed on it and you thought, yeah, I don't know if this is going to turn out well, it's going to have all the impact. And in the end, it turned out way better than you thought and you were pleased you invested, or if you had passed on it, maybe you wish you hadn't. And what did you learn from that experience?
Yeah, so it's maybe not one I've done, but it's the last investment we've done here at Natural Capital Strategy, which is a brownfield project in Iberia, and I already mentioned it. And I was very skeptical that this would work and that we would be able to produce any impact with that or look good. We're buying an existing agriculture operation, but how can we actually achieve any impact? And what I realized is that because we are doing a lot of greenfield investments, that could be convinced that there was actually a lot we could do on the impact and it fit all of our criteria. And on top of that, we were able to actually put in an asset in our 15-year strategy that is producing now immediately yield, which was highly appreciated by many of the investors, which also shows that sometimes you have to kind of not dismiss that you're saying there's no way we can ever achieve that, but actually do the hard work and do the analysis. Is it possible? And then you can be surprised that things are actually possible that you didn't think they were.
If someone wants to get into the natural capital investing space, where would you advise them to start and learn the trade?
So that's interesting. I know you always ask that, so I got some thoughts on that, and I think I would say I have 3 lessons for that. So firstly, don't get, like, for young people, I would say don't get intimidated, because I only told, or you helped me to tell my story here today. In a way, I only told you what actually really, really worked. But everybody's story is kind of told in retrospect. And in retrospect, often careers look much clearer and more straightforward than they are in reality. And I think that's something that I tell everyone who starts here. Sometimes it's like, wow, you have nothing, but I haven't started already 20 years doing that. Is it like, well, yeah, but I can also tell you all the things that didn't go right, all the jobs I didn't get, all the scholarships I didn't get in the end to do that. And I think that's something that's really worth for anyone to remember. Then the second one is, don't play for today's job. So, okay, you want to go into natural capital. The one thing I can tell you, when you're in 20 years into this, the job will look completely different than what you could ever imagine. I could not imagine that I'm doing what I'm doing today. And I think that's also worth remembering. So I think identify something that you're really interested in, and then think what could be the key drivers. You may get it wrong. So I said actually energy is a key driver, but maybe when you look at for natural capital, I would think what are the biggest things that can drive that this becomes a real investment field, and not focus on the existing jobs today. So that's that's the other. So I think the one thing that springs to my mind is technology. I would really, if I were going out, I would think about, okay, what technology can help us to advance this field. The last thing, my third thing is, don't be afraid to try the other side. In that sense that many people that come into sustainable investments, like, I only want to work for a certain type of investor. And I think what I learned in my career is by actually understanding the other side. So if you're, just to give you an example, if you're in climate, people say I would never work for an oil and gas company. I would actually say I would encourage people to work for an oil and gas company. You need to understand how they work. You need to understand their motivation if you want to change life. And normally these organizations are actually really good in what they're doing. So we'll also pick up a lot of excellent skills. But if you go in with the mindset, I want to change it, and that goes back to the whole point, I'm having more respect for people saying that they're saying I'm going into an organization and I'm changing the course by 1 degree. Often you have a lot more impact, but less visible than something which is much more louder, allows you to kind of shout from the rooftop what you've been doing. So I think those are the kind of the three things that I would say to anybody starting out to think.
Excellent. Martin, you've been very generous with your time, and I think we've about beat this natural capital thing to death today. Is there anything that you wanted to speak about or wanted to raise that I haven't asked you about today just before we wrap this up?
No, thank you.
All right. I've really enjoyed this. It was really great talking to you. Thank you very much for taking me through all this. I've really learned a lot about this today. And now tell everyone about your websites and social media and all that good stuff.
Perfect. So yeah, anybody wants to reach me, I'm on LinkedIn. That's probably what I use the most. And then our website is climateassetmanagement.com.
All right. And the best way for people to contact you directly on LinkedIn?
LinkedIn is easiest, yes.
Okay, Martin, thanks again.
Thank you.
And goodbye, everybody.
All right. Bye-bye.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.